Have you ever walked past a massive shopping mall or towering office building and thought, wow, I wish I could own a piece of that, but then realized you'd need millions of dollars just to get started? Well, what if I told you that you could actually own a slice of some of the most valuable real estate in the world for less than the cost of a nice dinner? That's exactly what REITs make possible, and by the end of this video, you'll understand how they work and whether they might fit into your investment strategy. So what exactly is a REIT? REIT stands for Real Estate Investment Trust, and think of it as a company that owns and operates income-producing real estate. Instead of you having to buy an entire apartment building or office complex, you can buy shares in a company that already owns dozens or even hundreds of these properties. It's like buying a tiny slice of a massive real estate empire. Here's how it works in simple terms. Let's say there's a company that owns 50 apartment buildings across different cities. These buildings generate rental income every month. Instead of keeping all that money, the company is required by law to distribute at least 90% of its taxable income to shareholders as dividends. So when you buy shares in this REIT, you're essentially becoming a partial owner of those 50 buildings and you get a portion of the rental income they generate. The beauty of REITs is that they democratize real estate investing. Normally, if you wanted to invest in commercial real estate, you'd need hundreds of thousands or millions of dollars, plus you'd have to deal with finding tenants, collecting rent, handling maintenance, and all the headaches that come with being a landlord. With REITs, professional management teams handle all of that while you just collect your dividend checks. Now there are several different types of REITs, and understanding these categories can help you decide what might work best for your situation. Equity REITs are the most common type, and these actually own and operate real estate properties. They make money primarily through rental income and property appreciation. Then you have mortgage REITs or M-REITs, which don't own physical properties but instead provide financing for real estate by purchasing or originating mortgages and mortgage-backed securities. Within equity REITs, you'll find even more specialization. Retail REITs focus on shopping centers, malls, and standalone retail properties. Residential REITs own apartment complexes, single-family rental homes, and other housing. Office REITs concentrate on office buildings and business parks. Healthcare REITs own hospitals, medical office buildings, and senior living facilities. Industrial REITs focus on warehouses, distribution centers, and manufacturing facilities. There's also something called hybrid REITs, which combine elements of both equity and mortgage REITs. Each type comes with its own risk and return characteristics, so diversification across different REIT types can be a smart strategy. One of the biggest advantages of REITs is their liquidity. Unlike owning physical real estate, which can take months to sell, you can buy and sell REIT shares on the stock exchange just like any other stock. This means you can get in and out of real estate investments much more easily. REITs also provide excellent diversification benefits. Most people's largest asset is their home, so adding REITs to your portfolio gives you exposure to different types of real estate in different geographic locations. This can help reduce your overall investment risk. Another major benefit is the dividend income. Since REITs are required to distribute most of their income as dividends, they typically offer higher dividend yields than most stocks. This makes them attractive for income-focused investors, especially retirees who want steady cash flow. But REITs aren't without their drawbacks. They can be quite sensitive to interest rate changes. When interest rates rise, REIT prices often fall because higher rates make bonds and other investments more attractive compared to REIT dividends. Also, since REITs trade on the stock market, they can be volatile and their prices don't always reflect the underlying value of the real estate they own. Tax considerations are important too. REIT dividends are generally taxed as ordinary income rather than qualified dividends, which means you might pay a higher tax rate on them. This makes REITs potentially more suitable for tax-advantaged accounts like IRAs. So how do you actually invest in REITs? The easiest way for beginners is through publicly traded REITs, which you can buy through any brokerage account just like stocks. You can also invest in REIT mutual funds or exchange-traded funds, which give you instant diversification across many different REITs. When evaluating individual REITs, look at metrics like funds from operations or FFO, which is similar to earnings for regular companies but adjusted for real estate-specific factors. Also examine their debt levels, occupancy rates, and the quality of their properties and management team. For beginners, I'd suggest starting with REIT ETFs rather than picking individual REITs. This gives you broad exposure to the real estate sector without having to research dozens of individual companies. Popular REIT ETFs include options that track the entire REIT market, or focus on specific sectors like residential or commercial real estate. Consider your overall portfolio allocation carefully. Most financial advisors suggest limiting REIT exposure to 5 to 15% of your total portfolio. This provides real estate diversification without over-concentrating in one asset class. REITs can be an excellent addition to a well-rounded investment portfolio, offering steady income, potential diversification benefits, and exposure to real estate without the hassles of direct ownership. However, like any investment, they come with risks and aren't suitable for everyone. I've listed a couple of REIT-style platforms in the description if you want to explore this topic further. The key is understanding how REITs fit into your broader financial goals and risk tolerance. Start small. Do your research and remember that successful investing is about building a diversified portfolio over time rather than chasing quick profits.